In today's episode, we are going to talk about how to reduce your taxes ethically and legally while running a wholesaling business. But before I jump in today's show, if you have not been over to nextlevelwholesaling.com and you want to run a highly profitable wholesaling business that runs day to day without you, head on over to nextlevelwholesaling.com and take the Next Level Wholesaling Assessment. It's going to have you rate yourself in the 4 core areas of your wholesaling business. It's going to take you like 5 minutes. Got a few questions, super easy, 100% confidential. And once you take that, you're going to be like, whoa, it's so clear on my very next step that I need to take to get my business basically doubling its profit. Okay, so go to nextlevelwholesaling.com if you want to make more money and work less hours. All right, so let's talk about how to reduce your taxes ethically and legally, because let's face it, Uncle Sam is your business partner. And if you're making any kind of money, he eventually is going to be taking about 50% of your net profit. Okay, so it is time to be a patriot, okay, and reduce your taxes ethically and legally, okay, so that the IRS will kind of love you, but hate your accountant, okay? So I'm going to share some really, really good ideas. A little disclaimer here. Run this by a licensed CPA or your accountant or your attorney or the IRS. This is just some suggestions. I suggest you ask your accountant about these things, not do any of these things, okay? I have done a lot of these in my business, and hopefully they will be a benefit to you. So my first recommendation about how to reduce your taxes is if you're not netting $200,000 a year in your business, and I'm talking about the actual business, I don't want you to worry about this, okay? Because if you're trying to save money on taxes and you're not making $200,000 a year, you're focused on the wrong thing. If you haven't purchased the no limit selling system, that's how you get there, right? You got to do big, fat, juicy wholesale deals, 50K a pop. You got to learn how to turn $1 into 5. You got to market like an absolute beast. Okay. My goal for you is to market with $5,000 a month minimum and turn that into 25 to 50, even $100,000 a month with some consistent follow-up and offers and selling and closing and selling for top dollar. So, I know that you can do it. But if you're not making $200,000 a year, what I need you to do is focus on getting there. And you can do that relatively quickly if you haven't bought the No Limit Selling System. Just buy it, listen to it, focus on it. Check out nolimitsalessystem.com. All right, very, very, very important there. Now, one of the things that I'm going to recommend for you to reduce your taxes is if you're doing big, fat, juicy deals, you are going to be running at a very, very high profit margin, and you're going to have money in the bank. And so I recommend that you hold on to 2 or 3 properties a year. Instead of wholesaling them or flipping them, you hold on to them for at least a year. Why is that? Because when you hold on to a property for a year, you actually get taxed at long-term capital gains and not regular ordinary income. So the difference is going to be about, depending on what tax bracket you're in, about 18%. You're going to make a lot more money either way, right? Is that normally if you were going to try to rush and wholesale a property, let's say you are only going to make $50,000. If you hold on to that property for a year and the market's appreciating, or you buy right, or you can take your time, or maybe you get it vacant, you might make $120,000, $130,000. So you're going to make an extra $70,000 or $80,000 a deal anyway when you do that. But if you sell it on long-term capital gains, you're going to save about 18% if you are at the higher tax bracket. Okay, so here's where I see really, really good opportunities, and I've done this. So whenever I have a house where there is a tenant who is living on the property and they have a long-term lease, like 6 or 7 months, a lot of buyers are really scared of this, right? They don't want to deal with the tenant, and frankly, they don't want to deal with a long-term lease. So buy the property, rent out the property for 12 months, leave the tenant in there, right? It's already making money, right? And then sell it in a year or 2. That's the first part of that. Now, here's where it gets really, really, really juicy. Let's say you do that with only 3 properties a year, maybe even 2, right? Keep all of them for a year, rent them all, okay? And this is where this is going to get awesome. Hold on for a year, sell them all. Let's just say now you have $300,000 or $400,000 profit. Instead of long-term capital gains, which is one strategy, the second strategy is to then 1031 exchange. Now, a 1031 exchange is when you take something where you were going to make long-term capital gains, right? You sell a bunch of properties that you've held for a year and rented, Okay, you can't do this on flips and you can't do it on wholesales. They've got to be rental property that you quote unquote put in use. You now can sell all three of these and now take all that profit, that $300,000, and roll it into a much bigger property, okay, completely tax deferred, meaning that you're not going to pay any taxes on that right now. For me, I would take that $300,000 and I'd buy $1 million mobile home park, get a loan, right? And now I'm going to take that $300,000, buy $1 million mobile home park, and now I'm going to turn that $1 million into $2 million. I didn't pay any tax up front on that $300,000, and now, boom! I basically just made $1 million by by buying $1 million home park and turning that one into two. Now, the whole process of turning $1 million mobile home park into two is a whole different podcast episodes. I've recorded some of those. My point is that it's like Monopoly. You sell the 20 houses and you buy the one big red hotel. Okay, and so take a look how you could take these little wins and turn them into something bigger. Okay, now the next part of the game I'm going to talk about is depreciation. Now, depreciation is something where the government says, hey, you own rental property. Again, this is not a flip or a wholesale. If you're just flipping a property right here, the government does not let you depreciate the property. They don't let you, count long-term capital gains. I'm talking about if you decide to hold it as a rental. Depreciation, if you buy, let's say, a mobile home park or a commercial building, or let's say you invested maybe into one of my mobile home park deals, you actually can get depreciation. The government said, hey, you own this asset, but we're going to let you count a certain portion of this asset as if it's decreasing in value. And that could be anywhere from like 3% of the value of the property all the way up to like 45 or 50% based on bonus depreciation. Okay, and that is a lot of money. For example, on one of my mobile home parks that we recently did, me and my partner, we got like a $370,000 depreciation write-off that first year, which was pretty darn exciting. Okay, now, by the way, you could do a whole podcast on that. The other thing that I want to talk about is something called the Masters Rule. And this one is really cool. And I believe they call it, and don't quote me on this, the Masters Rule, because people did it for the Masters. It was a golf tournament that some people came in town and rented out their primary residence. So you can rent your primary residence out up to 14 days a year, tax-free. Okay, so you can rent out your primary residence 14 days a year, tax-free. So you're like, well, Todd, how is that going to work? I don't want some strainers in my property. Awesome. Here's what I would do. You are required, if you have a corporation or LLC, to have quarterly meetings every quarter and to keep notes. So what I would do is have your company rent your primary residence and have your quarterly meetings in your property, pay rent from your company to yourself. Now, it has to be market rent for that property. So I would look in the area for what Airbnbs are for renting for in your area if you own a property, and then pay yourself for $15,000. So if the rent is, I don't know, $500 a day, then you're going to be able to basically make 14 days, about $7,000 a year. If it's $1,000 a day, depending if you got a nice house or not, it could be $14,000 a year. So that's a $14,000 write-off right then and there. Of course, talk to your attorney, CPA, and the IRS about that one. Next one is, I always recommend, as you're building your business, don't buy cars just to buy cars. Okay, don't do that. Don't waste your money. Don't do things that you're trying to keep up with the Joneses if you don't have enough money to fuel your business. But if it's time for a car, and you want to use that car in your business, then you can actually write off the purchase of that car or depreciate the majority of it. Okay, basically ask your accountant if it weighs a certain amount. And so for me, I've done that a couple of times. And if you're buying a $60,000 car, $50,000 car, $80,000 car, and you can afford it, right? Well, then you can use that IRS code. All right, next thing is family vacations. Okay, if you are going on a family vacation or travel, what I like to do is schedule a couple of my business meetings while I am there. And so with my family, if I go on vacation, it's expensive. It is very expensive. And so I will always have some business meetings while I am there. Little trick here, though, if you try to write off the entire vacation, that's no good. Okay, that's going to be the IRS, in my opinion, and probably your attorney's opinion is going to say no. So if the whole vacation costs you $10,000, I would probably try to write off the amount of vacation spent and the amount of time working, right? Use the travel and the accommodations and things like that, but just make sure that you are fair and honest and document. Keep it like that. All right. So I talked a little bit about depreciation. Let me talk about some of my two favorite things. And sometimes people get obsessed about taxes, but really this one is not necessarily tax, but it's about how to keep more of your money. You got to watch your expenses, right? Everything is not a write-off. Just because it's a write-off doesn't mean that you should spend it. And so you want to watch your expenses. You want to go through your profit and loss every single month, look through every single expense and say, hey, do I need this? Or can I renegotiate this? Or can I work with a vendor for some better pricing? Or do I need this employee, right? Are they performing or not performing? So that is really, really, really important. See what you can buy in advance. And so, hey, look, what do they say? A dollar saved, a dollar earned. And so that's really, really important. Number two, let's talk about increasing your deal size. Let's increase your tax liability, and opposite of this. Let's make it so that you really, really need this tax advice. Make sure you're doing big, fat, juicy deals. All right. So just like I said, you could save money if you take a deal that you were making 25 on, and now you can make 60. Hey, that's additional $40,000, right? So now that's more tax money and more money in your pocket. So if you have not bought the No Limit Selling System, you want to do big, fat, juicy deals. You want to eliminate the anxiety of talking to sellers. You want to shrink the closing timeline and get paid faster, you must invest in the No Limits Selling System. You got to do it, okay? So reasonable, nolimitsalessystem.com. Next one, check out a cash balance plan. A cash balance plan just works kind of like a 401k in your, if you had a job, but if you have a company or like an S Corp, you can basically set one of these up and take a portion of your income and put that away pre-tax. So I put away $50,000, $60,000 pre-tax for my company, for my salary, many years now. And that's basically a $60,000 tax deferral. Now, when I turn 59 and a half or 60 and I start taking that money, I will have to pay taxes on that money. But all that money grows tax deferred, which I'm really excited about. So again, make sure that you keep some of your money, enjoy it, but you want to defer some of that. Next one is, and this is my final one, is pay your kids. There is a lot of little items that need to be done in a business. And so once your kids are old enough, you can pay them appropriately for their company, for their work. And so the what they call the the standard deduction, not 100% of that number. I think it's around $13,000 or $14,000, but you can pay your kids, which is going to be a tax deduction for you, about $13,000 or $14,000 a year. For you, that's going to be tax-free. For them, it's going to be pretty much tax-free in that they don't have to pay any taxes up to a certain amount, that's called the standard deduction. And so again, make sure they're actually doing the work, make sure that you're paying them appropriately, make sure you're documenting that, but you can give them that money and for the work that they do, and it'll be a tax deduction for you, and they will pay very little, no taxes to that. You might have to pay some payroll taxes and things like that, but the money is very reasonable. Okay, so I'm going to review. Number one, if you're not making $200,000 a year net, don't worry about it. By the No Limit Selling System, increase your deal size, do better deals, follow up, get the number there. Number two is hold on to a couple of properties a year, especially if they already have tenants in them and those tenants are already paying. Don't forget about the 1031 exchange if you're using that. Use depreciation if you're buying some better assets, especially if you're using that 1031 exchange. Don't forget about the IRS section. They call it the master's rule. You can Google it. Your vehicles, your vacations, you can write off a certain amount of that, portion of that. You want to watch your expenses. You want to increase your deal size. Check out a cash balance plan. And don't forget about paying your kids. So don't forget to head on over to NoLimitsRealEstateInvesting.com or Next Level Wholesaling. Get on our email list, take the assessment, and let me know if you know any other ways to reduce taxes ethically and legally, if it's not totally exotic. Anyway, I'd love to hear from you. You can leave a comment on YouTube or reply to the email that you get from me, and I can't wait to talk to you on the next episode.